Hello, my name is Daryl Robertson. It's May 2016, and next month the Federal Reserve is either going to raise interest rates or do nothing. And much depends on that decision. For 7 years, after the economic collapse of 2008, the Federal Reserve lowered rates to an unheard of, unprecedented 0.25, almost 0% interest rates. They kept it there for 7 years because they were trying to liquefy markets after a massive deflationary collapse in demand, and they were afraid that the global economy was going to collapse. Well, when you do this for a lengthy period of time, it totally upsets the dynamics of credit and debt markets, and you need to normalize markets, and the Fed has been looking for ways, for evidence that the markets are normalizing, allowing it to bring interest rates back up to the 2 to 3, 4% levels that were there in perpetuity before the economic collapse. So in December 2015, they announced that finally they were going to raise rates. Well, what happened in January? Global markets sold off, losing $8 trillion. This was massive. Not only the United States, but especially China and all other emerging markets, they just froze and collapsed when the United States actually raised the rates that had been threatening to do so for probably almost 2 years. Well, the next month, the Federal Reserve said, listen, we're not going to raise rates the 4 times that we were going to in 2016. We're only going to raise them twice. And immediately markets recovered. And they're back to basically where they were before they collapsed. But now as we approach June, the stock markets are selling off again. In the United States, in the S&P, all investor classes, except for corporations, are sellers and not buyers. So as we approach next month, the question is the Fed going to raise rates? And probably the 0.025%, the minuscule amount that it did then, a token amount. Because to do so would choke off whatever recovery that they have in progress. And it's really not a recovery. Since 2009, with trillions of dollars put into the global economy, markets have not yet recovered. What they have done is they've stopped them from collapsing. They delayed the ultimate economic collapse that was set in motion in 2008, and it is still going, and in fact is gathering speed. It's in the name of deflation. This is what central banks are afraid of. But for investors, right now, the most important issue facing all the markets is whether or not the Fed is going to raise rates. Now, in January, market pundits did not believe this was going to happen. Why? Because they knew that if the Fed did raise rates, markets would collapse. And they didn't think that the Fed had the requisite balls to go ahead and do what it said it was going to do, actually raise the rates. Well, the Fed went ahead and did it. I think, I'm not sure what the Fed's going to do, but I am sure that their intent is, if they can convince themselves that there is enough traction in the U.S. economy, that they are going to raise rates because they want to normalize it. And if they do, you're going to see a massive sell-off in the markets. What will happen? The only thing that will stay its hand, if markets start losing traction between now and June when their decision has to be made. So my advice to you as investors is to watch very carefully. Supply and demand is no longer the underpinnings of a free market because we no longer have free markets. These are markets determined solely by credit and debt. Supply and demand is merely a background, a fundamental leftover from previously free markets. In 2007, I posted my book called Time of the Vulture, in which I predicted an extraordinary economic collapse was going to happen. I had been studying the economy for 10 years. That summer, within 2 months after I presented my report at the Positive Deviant Network, $2 billion hedge funds collapsed. Bear Stearns, they went to zero. The next year, global markets gave way, Wall Street banks collapsed, and the rest, I think you know, is history. What you are hoping is that they've arrested the collapse. I want to tell you, They didn't. What they did do was delayed the collapse. In January 2016, the collapse once again gained strength when global markets sold off. Next month, they may lose even more. These are very dicey times. We don't know what is going to happen except that the inevitable will happen. A deflationary collapse in demand is underway. The aggregate levels of debt are too great for central banks to reverse, for central banks to reinflate using cheap interest rates. Negative interest rates are only the beginning. They are in what I call the end game. Be careful. What I said in my book was that the time of the vulture is here, and it feeds not upon the stored up wealth of the bear or the pastures of the bull. It feeds upon the blind denial and ignorance of the ostrich. The ostrich are investors that are still hoping that yesterday will continue till tomorrow. It won't. These are incredible times. This is a paradigm shift of immense proportions. The 300-year-old Ponzi scheme of credit and debt put into motion by the bankers with the Bank of England in 1694 is now ending. When I wrote my paper 10 years ago and predicted the collapse, it happened. It is still in progress. In the next few weeks, in the next probably year, maybe less, I'm going to go over each one of the 36 topics I covered in Time of the Vulture and compare it to what has happened now and what has happened then. I want to read now from the first topic that I wrote back then, which I wrote in the middle of May 2006. This is what I said. Topic 1. By April 2006, the flood of easy credit had driven prices in all markets, housing, stocks, bonds, commodities, derivatives, to multi-year highs. But in 2005, central banks began raising interest rates to contain inflationary pressures set in motion by the previously low rates. With interest rates rising in May 2006, the U.S. stock market began to falter, with the Dow suffering multi-100-plus day losses, and emerging markets took the biggest hit of all, losing an estimated $5 billion of value in a week. From mid-May to mid-June in 2006, the total loss for world stock markets was $2 trillion. The financial bubble created by low rates had peaked. The central bank policy of easy credit ended in 2005, and the higher interest rates began to deflate the bubbles that low interest rates had created. Easy credit led not just to higher asset prices, but to higher prices in general, to inflation, and central banks raised interest rates, popping the bubble, leading to massive losses. I said that the $2 trillion sell-off was not the collapse that I was writing about. The $8 trillion sell-off in January of 2016 was not the global sell-off that I was writing about. It is still in front of us. But this is 9 years after I wrote those words. We're 9 years closer. The time of the vulture is at hand. Be careful. Next time, I'm going to talk about the topic number 2, which will be the world that once was is no longer. Buy gold, buy silver, have faith. Darrell Robert June.